Hey everybody, it's Eric Lay, producing branch manager and mortgage loan originator with Guaranteed Rate in Boise, Idaho, joined by Charlotte Jean. Charlotte, how are you doing this morning, and happy belated New Year?
I'm great, and happy belated New Year to you too. How are you?
Yes, yeah. Well, no complaints except for the obvious things that we would love to have a few more people buying homes, the rate's a little bit lower, all of those things, but we're not here to complain. We're here to help and educate people. So no complaints is the long answer long. Well, I thought we would talk today a little bit, and you and I were speaking before we went live here, just about again, we've hit this before, but it bears repeating, this dynamic of what causes mortgage rates to move. Because unless you live under a rock, right, and you're just not seeing this, you have heard something over and over and over, month after month. The Federal Reserve is raising rates, right? It seems like it's happened all year long, and it has, right? There have been a lot of rate increases by the Fed, and that grabs all of the headlines. It gets all of the attention. But as you and I know and talk about all the time, and a lot of our viewers probably don't realize, the Fed raising interest rates isn't the most important factor in where house mortgage rates end up being. So right. I thought it would be a good time to dive into that a little bit today. So permission to share screens?
Absolutely. Let's go for it.
Okay, cool. Well, I thought it'd be a good thing just to start off by just talking a little bit about inflation, because that in its base is what causes mortgage rates to move. And we're going to dig into this just a little bit more, but I thought let's just start with the definition from the dictionary. So Google definition of inflation, and here we go. A general increase in prices and fall in the purchasing value of money. Now, how you think about that can go a lot of different ways. And the way I think about it is quite simply this. Let's pretend it's 3 years ago, and let's pretend that we go to the grocery store, because everybody has to go get groceries. If you bought the same exact grocery cart of food 3 years ago, compared it to today, today's is going to be significantly more expensive than it was 3 years ago. And I think everybody gets that, right?
Yeah.
That's the easiest way to think about inflation. You're buying the same exact things as you did yesterday. I mean, we'll call 3 years ago yesterday for the conversation, but it costs 50% more or 70% more or whatever it is. Same exact items costing more money. That's inflation, a period of rising costs in an economy. So with that said, what does that mean for interest rates and mortgages? Because again, that's what you and I do. You sell houses. I help people get the financing to buy the houses. And let's talk about what that means, because I think this is the thing where the message gets lost in the media with the Federal Reserve and the Fed speak that happens all the time. So let's do a quick video check. Can you see the slide? Inflation drives mortgage rates. Okay, cool. So what we're looking at here is a 4-year window. So 6-month increments across the bottom there of comparing inflation to 30-year fixed mortgage rates, okay? Now, inflation can be measured a lot of different ways, everybody, but what we're looking at on this particular slide is the consumer price index. So it's a moving index that shows the cost of things. As it moves up, that means we're going into a period of higher inflation because the cost of those things is getting more expensive. As the CPI goes down, the opposite is true. The cost of things is getting a little less expensive. Now you can see going back for 4 years, okay? CPI is the pink line on the bottom. The mortgage rate is the line, the blue line on the top. And you can see that they don't follow each other perfectly, but we didn't see mortgage rates get above 5%, okay? Yeah. And that's going back to January of 18. Then we get to this gray vertical bar here. That was the very brief pandemic recession that we had, okay? And you can see what happened to the consumer price index. It dropped off dramatically because nobody was out doing things, right? Nobody's out buying things. And so there isn't as much money and spending that's out there happening because we were staying at home, sheltering, right? All those things that everybody knows and remembers, okay? Well, the Federal Reserve had to step in to help support that. And that's what this white bar here is, QE, which is quantitative easing. Now, it's not just the Fed who came in and started buying mortgages to keep rates lower, because they were doing that. They were creating an artificial period of demand for mortgages as an investment. And as we've talked about in previous episodes of this, when there's more demand, the rates go lower. Okay, so you can see there was a period here of about 2 years where the Fed stepped in and bought mortgages to try to keep rates lower. Okay, well, when things started opening up a little bit and the effects of the pandemic started kicking in, that's when the cost of everything started going up. And you can see the pink line crosses over, which it had not done before, and started coming up really high.
Right.
The mortgage rates stayed really low until what happened? The Fed stopped buying rates. And this is something I want to pause and just make sure everybody gets. The Federal Reserve was buying mortgages, that's stimulating of buying mortgages to keep rates lower, sometimes to the tune of $50 billion per month. And they were doing it, you saw in that for almost 2 years. So if the Fed stops buying and they step out of the game, like, oh, we're not doing this anymore, you have to have somebody else come in and buying at that level in order to keep that demand the same.
Right.
Well, sorry, there's no other $50 billion laying around out in somebody's safe or in the coffers that's ready to be deployed right that. Like, it just doesn't exist. So when you take a buyer the size of the Federal Reserve out of the system, now we have a real lack of demand. Think about like a vacuum. There has to be something that comes in there and fills that, right? So if we go back to that screen again, that explains why mortgage rates here at the end of the quantitative easing period started really moving up quickly, okay? As inflation goes higher, rates have to go higher. That's the correlation that you have to see. They largely stay connected until something like that happens. Now, if inflation is going higher and we expect rates to go higher, the opposite is also true. If inflation starts moving lower, then we would expect mortgage rates to go lower. Now you can see it was back in September, this is at the top right of the graph, that's where mortgage rates hit their highest point in this recent period here that I'm showing everyone. But they rolled over a little bit there and they started moving lower. Not coincidentally, because inflation has started to come back. And you can see the pink line there. Inflation has been moving lower. Rates will follow suit. Now, what I want everybody to take away from this is tomorrow we have a CPI report that's coming out. CPI, this core consumer price index. Let's take a look at going back a year and a half on what this means. So here's how it works. A lot of numbers on here. Again, I apologize for that, but it's an important thing to grasp. Tomorrow is the December reading. It's January, so we get the December reading for inflation. So the way that CPI works is it's a 12-month average. So this number right here, December of 2021, that number is going to fall off and we're going to replace it with December of 22. Now, what's probably going to happen because of the Fed raising rates, creating everything to be more expensive, higher rates do that, right? We're expecting inflation to continue to move lower for the same reason. And you can see what's happened here just in the last 4 months. October, November, December, January, February, even you could say 5 months at the start and end of 21 and 22. Those were very high numbers. And we're replacing them now with lower numbers. So if the December reading from last year at 0.6 gets replaced with, I don't know, let's just say another 0.2% or something like that, that means inflation is going to drop by 0.4%. And if that happens, and again, we don't know because that's not come out yet, right? But if that comes out and it shows that tomorrow, that's going to be another downward revision of that 12-month rolling average of inflation, and inflation drives rates. So our thought, and again, we don't have crystal balls, we can't predict the future, but we really feel like the table is set with some of those higher numbers from 2022 eventually going to roll off, that we're going to see inflation continue to move lower. And if that trend continues, we should see mortgage rates continue to move lower. Now, again, there's a lot more to it than that, but that is one very important component of how mortgage rates get determined that a lot of people don't realize and think about. So I thought it would be important to show that graph today and how that 12-month average works, and especially how it correlates to mortgage rates. So, whew, I'm tired of talking. Any thoughts or any takeaways from that? Because again, I feel like this is something that gets missed a lot, and especially at the media and the Federal Reserve grabbing all of the headlines.
Yeah, it's a lot of information. It's a lot of numbers, and it's definitely something that's not explained very well
I might have lost you there, Charlotte. I'm not sure if you have a freeze on your side or not. Charlotte, are you there?
Can you hear me?
Yes, there you are. You're back.
Okay. For some reason, it's not working very well. So we should probably wrap it up.
Okay. Yeah. Any parting thoughts, anything on that before we wrap up?
No, I think that if people have questions, they should definitely reach out because this is very interesting information and how it plays into the housing industry. Mortgage rates are very, very important to what's going on right now. So just reach out if you have more questions.
Yeah. Well, the last thing I'll do is in on a total selfish, well, I can't even talk, selfish, shameless plug. I was looking at this before we went live. That's my current rates. I can't remember the last time all of them started with a 5.
That's awesome.
Because we've been in such a high mortgage rate period here for so long, right? So that all of them started with a 5, I was like, we're going in the direction. That's the right trend. Move a little bit lower. So
I agree. And we're still in the market right now in the real estate side where we're seeing a lot of concessions. It's not necessarily the multiple offers still, although I have heard in some areas they are transitioning back to multiple offers. So the mortgage rates are much better. Let's talk if you are, if you have questions about what your next steps are.
Yeah, absolutely. So when we end this Facebook Live, Charlotte and I will go into the comments and we'll put all of our contact information in there for you to reach out if you do need us or have questions. And I'm also going to put a link to that page that I just showed you with rates, because if you just want to follow what rates are, I mean, certainly you can go to Google, but just know that's taking an average of a lot of different lenders and it's coming up with a broad average that is going to be broader. But if you have questions for me and you want to follow mine specifically, just bookmark that page because they're always updated on there. You just come back to the page and there they are. So,
all right.
Okay, great.
Thanks, Eric.
Yeah. Good to talk to you again and again. We'll put our contact information in the comments below for you. If you have any questions about buying a home, Charlotte's your girl. If you have any questions about financing and rates, I'm your guy. Reach out to us. We're here to help and be a resource. Thanks again. We'll talk to you guys later. Okay. Bye.